Morning, everybody. It's Wells Only, and I'm doing a chart set for July 22nd as of the 000 UTC hours crossover. So let's just get into it. Little disclaimer: the information displayed in this broadcast is known to cause increasing amounts of FOMO. Wells Only is by himself and is not responsible for any losses you may accrue for having weekends. Remember, it's about the math. If you don't respect the math, you end up like these guys, and they're looking okay right now. But we've been through this before and we know what comes after. So there's a reason this is always there. And there's a reason this is always true. We'll get to that. All right. Now let's start off with what an economy is. An economy is essentially a construct of two buckets, if you will. One bucket is the private sector, which is the value generating uh, nexus of the bucket. And then you have the public sector, which is the life sustainment, life improvement, supposed to be the life sustainment and life improvement nexus of the bucket. Uh, so the whole point is the private sector creates the value, the public sector receives a cut of the value created in return for their services and administrative capacity, right? But what ends up happening is that the funds that they receive actually end up getting mismanaged, and we don't see what we're supposed to see, and then as a result, what ultimately happens is a desire for more funds from the public sector for the public sector are required or are extorted from the population, right? And this is what we typically see um, in pretty much all aspects of societies, regardless of their so-called cultures, because in reality they're just masked, right? If you look around the world, you see that every government pretty much operates the same, barring a few inconsistencies here and there. But ultimately, they're all just looking to fleece you however they can, whether it's at the cash register or at your paycheck or, I mean, you name it, right? We are all living and we're all adults and we all spend money and we all can read receipts. So, while they're just taking 20 to 30% of your paycheck, they're taxing you everywhere else, right? And if you add all those taxes up, you're at least paying 50% to them. So where are all these monies going? Because they're not going to where they're supposed to go, and this is what's essentially debilitating the private sector, right? People can't even hire folks right now because these guys are just giving out money that they're taking. So just one of the many many issues, right? That happens when benevolent dictators run the asylum. So moving on. So here we're looking at the market cap dominance for the top 100 in crypto, currencyonomics.com as a source. The way that the chart is laid out is we have HEX in pink, 19 months old, versus the rest of the top 100, which include Ethereum and Bitcoin, of course, and they are direct. And we will see why as this chart goes on. And this was for the 18th of July. We move on to the 20th of July, go down a little bit, and then the 21st we go up a little bit, and then again we're down a little bit today. But at one point we were at 3%, 3.5%, and this was just last week. So while everybody else is looking sour, Hex is gaining on the rest of the market, and we'll keep tracking this data point just to look at how cool it is over time, because it really is cool. Give me a second, guys. PowerPoint. There you go. First 584 days live, and what we're tracking here is the respective duration of each respective coin from inception: Bitcoin, Ethereum, and Hex, along with the T-shares for the first 584 days of each of their respective existences. Now, important thing to note is that Bitcoin is only at 1,074, 75 rounding up. Ethereum is at 2,370. 9 rounding up. This is the orange one for Ethereum. Bitcoin is the yellow one. And then you have the HEX index at 68,198. And then you have the T-shares index at 125,872 rounding up. Now, HEX just came out. These are the originals, so to speak, right? And look at how much it's outperforming the originals to the tune of basically 40 to 1 for Bitcoin and 20 to 1 for Ethereum, or more actually. This is 70. Sorry. So 35 to 1. Uh, or really, I'm just rounding up. But you guys get the point. The outpacing is ridiculous. And this trend line that I've added to the T-shares right here just signifies the type of return, the nature of the returns for T-shares and HEX, right? Because over time, the longer you hold on, the higher your values are going to be because that's log base 2, and that's how it works, right? While the steepness happens early on, over time, you just have to hold on for the market to continue to do what it does mathematically, right? Because this is math and code after all. And you see the trend line for Ethereum is like log base 10, which is not as fancy, or shall I say as powerful as log base 2. Bitcoin, we can't really even determine one from that one yet. All right, so this is the HEX post Big Payday chart. And what's Big Payday? Big Payday was one inflationary event that you're going to see for HEX. Everything else is a function of the T-share rate, and we'll get into that. But as you can see, since Big Payday, which occurred here, right, the market rode up into Big Payday November 1st and sold off into it November 19th. And ever since then, it's pretty much been just a little bit of sideways action and just some consolidation before up and to the right constantly. That's all we're seeing right now. So the HEX post Big Payday index is at 2,852, while the first halving is significantly below it at 784, rounding up. The third at 446, with the second at 168.5. And we're just outpacing them. I mean, it's not even the race, right? I mean, 240% versus the first 1,200. Give me 1 second, guys. All right, guys, back at it. Well, long story short, we're significantly outpacing each of Bitcoin halvings, and we have constant mini halvings, and that's how HEX works, which is outstanding because if you're a staker, you're receiving all of that inflation, which basically means you're benefiting significantly from the system and how it operates, which is why you're always winning. All right, now here we have T-shares to Ethereum in pink and T-shares to Bitcoin in orange. As you can see, we're 8.5% in terms of the dollar value as a percentage of Bitcoin. T-shares versus a Bitcoin, and the dollar value of a T-share versus the dollar value of an Ethereum is at 137%, meaning that the T-share is worth more than an Ethereum at this present point in time, which is crazy because we were not there a while ago, right? So this is the T-shares building value and sustaining them and maintaining them and increasing the value over time, which is great. Here we have T-shares, dollar cost of T-shares at $2,738.88 versus the dollar cost of 10,000 hex at $1,482.62, which yield a T-share rate, which is merely these two values, dollar cost of a T-share and dollar cost of 10,000 hex, divided by each other, which yield a T-share rate, which is essentially in this format a leading indicator of where the T-share rate is going. 18,473 hex per T-share, which is significant. We're currently at 18,279, if I remember correctly. Right now, the APY has reduced itself from an second all-time high of 62.59% yesterday's crossover on July 21st to a meager 41.8%, which is just crazy. And it's just a function of how the system works in terms of the how it pays out the APY, which is a function of the coins staked out of the circulating supply. We'll keep it moving. So here we have the HEX index again lined up versus the payout per T-share sum line, which is letting you know how many HEX you've received per T-share if you've been staked since day one. Now, what we want to highlight here is how HEX essentially follows the value proposition around, right? Because if you look at this line over time, all it's done really is track it, and the scaling merely just changes to coincide with the move, right, and the gain in the value in terms of the price versus the gain in the value versus the payout per T-share. Now we're going to look at this next chart, which is just merely the payout per T-share in percentage form, right? This is just the index format of that number, and it's 200,000. Give me a second. Yeah, it's 200,000. So wait, I don't think this is updated. Give me a second, guys. All right, guys. Sorry about that. The payout per T-share sum index is merely an indexed representation of the payout per T-share sum line. Essentially, the percentage return, and you would just merely take 100 off of this value to get the actual percentage return. So the index value is 217,664 rounding up, meaning the percentage value return from just being staked alone is 217,564 rounding up. And this is, folks, for just doing nothing. That's what staking is. You buy Hex, you stake it, and you make it. And it's that simple. All right, guys. Sorry about that. We're going to continue here. So the payout per T-share sum index, again, is a representation in index form of the payout per T-share sum line, which is a representation of the cumulative sum, meaning all of the hex paid out to anyone that has had one T-share since inception. And that number ends up being a whopping return of 217,564 rounding up, because again, we just remove 100 from the index value in order to attain the actual return figure. Payout per T-share index is showing now a index value of 565 rounding up after being all the way up at 860, which is the second most all-time high. And again, this is just letting us know how highly valued the system is at this point in terms of what it is paying out to the staker class in index form. And this is essentially saying it has increased its payout 5x since inception, given that it's at 565 on an indexed value. And now here, what we're seeing is daily payout index, which is now reduced from 26,000, I think it was at, to 18,386. And again, this is just a systemic valuation, right? Like this is just what the system is paying out on a daily basis in index form. So if you want the return value, it would just be a return like value, right? Because it's not really a return, it's just a rate of change more than not. That would be 18,286. So we're just going to keep it moving. So this is the HEX payout metrics post big payday. And as you guys can see, we had a payout of 6.231 HEX per T-share yesterday from a systemic payout of 68.149 million from a total T-share count of 10.936 million trillion shares. And again, this is again a function of emergency end stakes. We had a pretty sizable chunk come out yesterday again. And otherwise, the line should be down here, right? Just like the payout per T-share line should be down here, or I'm sorry, down here, just like the daily payout line should be down here. We're just gonna keep moving, and now this is the everybody gets paid chart in days. What we're looking at here is the hex price, the payout per T-share average all time, and the rolling average of 28 days for the payout per T-share and the 55-day average of the payout per T-share, which is the magenta line versus the pink, and then the orange line is the 28-day. As you guys can see, the all-time average is still creeping up. It was at 4.038 previous, and today it is at 4, or for this crossover's data set, it is at 4.042, with a hex price of 14.82 cents, giving us an average of 6, 55-day average of 6 hex per T-share. Or 6 payout per T-share, or 6 hex in terms of payout per T-share. And then the payout per T-share average of 28 days is 6.2 hex. So this chart is just something to behold, and it's gonna be a slow moving chart, right? But it's gonna give us a lot of information as far as valuation. At least I think, because with Hex we just never really know, given that it's so new, what the data is actually going to show us over time. It's just best to take a gander and assess it as it goes along. And now we're getting into the expiring shares charts. And as always, this is what gets the T-share rate to go up. So when a stake ends, what happens is that the T-share rate continuously is going up. So when you start your stake, by the time it ends, it's not going to be the same rate. So the system accounts for that at the end of your stake. And with that, it reduces the number of T-shares you can acquire again at that point in time with the quantity of HEX you have at hand, given all the HEX printed from the system. So what that ends up resulting in is in a higher cost basis for T-shares at that point in time. In other words, it continuously makes the T-share rate more expensive, and in result, it makes the dollar cost of a T-share more expensive. Because the T-share system is always going to ratchet up because the end stakes are always happening. Specifically because we always are front loaded, like we're seeing here, with the stakes at the front of the time curve for HEX. It's the staking ladder, right? This is basically the time curve for the next 15 years, because that's the max, 15.2 years, because that's the max for HEX in terms of staking duration. So as we can see here for the 13th, we got 46% approximately. And now on the 18th, we dropped down to 42 approximately, while August creeps up to 37% or so, it looks like, from, I can't even tell where this is because it just looks like it's down here. 20 something percent, who knows? But on the 20th, it picks up again a little bit further to 38% or so. While July drops to about 41%. And then as of this morning, it's at 40% for July. And next month, August, is at 39. So as always, we're seeing the stakes rolling along the curve, and the time duration curve. And this is what's constantly going to keep the T-share ratcheting up with respect to the explanation that I gave earlier. And this is why, as we'll see in a minute, the correlation chart between the dollar cost of HEX and HEX is so important. And we'll get to that. So this chart is the all-time HEX versus Ethereum correlation chart as of the crossover's date. And this is the HEX versus BTC correlation chart. Now, first thing to note is the correlation is 0 for both, and is denoted by the R squared here, 0 and 0, right? Besides that, we have the HEX returns on the x-axis and the Ethereum and Bitcoin returns on the y-axis. All right, so what is this chart showing us? It is showing us an XY plot representation of each respective data point from each respective data point in time, right? So each data point is the X and the Y plot for Bitcoin and Ethereum, right, within their respective axes, and those returns are posted on this data point. So for HEX, it would approximately be 30%, and for Bitcoin, it looks like it'd be approximately 11%. So that's the X. 30% is the X, 11% is the Y in this case, right? So long story short, what this chart is showing us is the preponderance of where the returns lie, meaning how often are the returns positive versus negative. And as you can see for HEX, the majority of the returns are on the right side of the zero axis, meaning they're grouped primarily on this side. Whereas on the left side, you don't really have a lot of dots for HEX. But when you're looking at Bitcoin or Ethereum, it's pretty spread out. So the grouping isn't really conducive to allocating capital to that asset. And it's the same thing for Ethereum. And if you look at the zero line for both, you'll know that there's more points on the negative side for Ethereum and Bitcoin than there are positive ones. Whereas with HEX, again, it's not an issue. So HEX is clearly the positively skewed asset with respect or versus Ethereum and versus Bitcoin with no correlation. So it's the superior asset to invest in. Now we have the rolling correlations chart. And again, this is the correlation between the dollar cost of the T-shares and the price of HEX. And as you guys can see, it's strengthening on the 55-day basis, which is the strongest one. And this one is tracking at 99.98% versus a HEX price of 14.82 cents. And this is just strong, right? And this is just letting us know that as long as the dollar cost of a T-share goes up, so will the price of HEX. And here we have the HEX, or the dollar term chart for HEX, the payout per T-share, and the adjusted value of HEX, which is just merely the sum of HEX and the payout per T-share. And yesterday's, again, price at the crossover was 14.82 cents. giving us a payout per T-share with respect to the 6.231 hex paid out of 92 cents, giving us an adjusted hex value of 1.07 cents. And again, this is just where the system builds value over time and where price usually tracks behind it, because the pink and the yellow line are really leading indicators, and hex price follows because this is the value building over time, right? Because the payout per T-share is what the stakers are receiving hex, right? And the system is always going to make that more costly over time, as we discussed earlier, with the T-share rates ratcheting every time somebody ends a stake. So this is why I put this exponential trend line on here, just to highlight that true nature of what's happening in this data point, right? This data set, because they're all going to really just act in accordance with what's happening in this line, which is just strictly an exponential payout scheme, right? Because it's always getting a little bit more expensive every time somebody ends a stake. And that's important to understand. Now, this is the HEX price to earnings ratio. And what this chart is telling you is how quickly you can attain your capital within 1 year once you invest, right? So this is in 16% of 1 year, you get your capital back. At one point, it was 10.5%. And this is if you were staked at the time, right? Because you got paid out in accordance with that at that point in time. So this is versus the all-time low of 551% for the S&P 500 price to earnings ratio, which occurred at the almost near the end of World War I in October to December 1917. So is there value in the HEX system? Yes. Should you attain that value ASAP? Yes. How is it going to change moving forward? Hard to say, because that's going to really depend on the quantity of HEX that is paid out by the system. So the more HEX paid out by the system, the more value you're attaining. And if that number ever does start to decrease, well, then the payout per T-share, the HEX price to earnings ratio is going to start increasing and becoming more expensive over time. And just to highlight, this is where we are, because this chart is a comparison chart between all the tech stocks that we all know and love: Apple, Microsoft, Google, and we also have Bitcoin on here as an all-time chart. And the reason I have this chart is because what we're seeing here is that every market eventually trades the same. And why is that? And that's because humans are interacting with this network, or with these respective networks. And if you haven't seen my first video, which is how cryptos work, it goes into detail into how cryptos work in specific HEX, but it does apply to cryptos overall. And it's just important to know, because this is how ultimately markets work, because humans are the ones interacting with that system, right? And we're always going to be the cost of growth, because there's always a little bit of humans and a lot of humans, and then more humans are following the trend, right? That's just typically how markets work, and that's what we end up seeing over time, hence the network effect. And this is pretty much highlighting how the system pays out interest for HEX. And as you guys can see, it's as a function of the coin staked as a percentage of the total supply. So if 10% of the supply is staked, then that means the yield must at least be 36.9%. But as of now, the staking percentage is like, let me see. Graphics. 9.539. So it just keeps getting smaller and smaller, which is great if you're staked, because that increases your APY. So if it's 9.539, that means we're close to 41%, because we're technically only half of a percent away from reaching 9%. So that's why our payout, or our APY payouts, are like 40%, 41%, because of the, or higher, right? Because of the emergency and stakes that get paid out on top of that. So how does the system pay out HEX on a daily basis? Well, let me explain. The system is designed to pay out 3.6%, 3.69% inflation on a daily basis, right? And this is the floor, meaning if the system is 100% staked, that's the only yield everybody's getting, 3.69%. That's it. And everything with the system will calibrate with respect to that. right? Because the number of circulating coins will decrease, the number of stakes will increase, the number of expiring shares will increase, the T-share rate as a result will increase, right? Because what we're saying here is that 100% of the coins are staked. Not for how long. So we're just talking about one facet of this equation. So if everything is staked, meaning 100%, that is all the system is going to pay out max. Unless there are emergency and stake penalties, then we'll get 3.69% plus, right? Just like since the staking percentage right now is basically 9.5%, we get around 40 to 41% plus because of emergency and stake penalties, right? And that's essentially how the system works, right? That's how it pays out interest every day. It calculates that 3.69% inflation on a daily basis and it produces it, and that's where the daily payout comes from, right? And then over time, as the staking percentage changes, the penalties paid out on top of that inflation change, right? And that's all it is. So I hope that makes sense. If you have any further questions with regards to that aspect of the system, definitely do let me know, because I know how the system pays interest is a very important question, and it's a function of the inflationary nature of this system, and that's pretty much it. So that's all I got, everybody. Hope you guys have a good day, and we'll be in touch.